on the market and what we're thinking about the world as we look forward through 2023 and 2024. And then Ian and I together are going to give you an update on the global direct funds, their performance, positioning, what we've been up to, and what they're looking like underneath the bonnet as we sit here today as well. Just to throw some lovely photos of ourselves up beforehand, or maybe not so lovely. Ian and I both run the Global Direct Funds together. We're both partners at Evelyn Partners, have been working for the respective different sides of the business for over a decade. I look after the equity component, so the stocks and shares component of the Global Direct Funds. Mr. Kenny looks after the bond component, but we work side by side in terms of managing the portfolios together. So maybe just starting with a quick recap of what's happened in stock markets over the past 18 months. I'm sure you know as well as we do that it's been an incredibly turbulent time for asset prices globally. This slide is just showing you what's happened to stock markets around the world since they peaked in December 2021. And you can see that a significant sell-off across pretty much every stock market through 2022, driven by inflation, but principally the really significant interest rate rises we saw to try and combat inflation globally. But since October last year, even though it doesn't necessarily look like it, we've seen a quite marked recovery in share prices around the world. We've kind of shaded 2023 in blue. It's been a general theme of recovery in all stock markets through this year, but with periods of turbulence. You can see in February and March what we're calling a banking crisis with a small b and a small c, where we saw a number of regional banks in the US go bust because of the sharp interest rate rises we'd seen over the past 15 months at that point. And in Europe, Credit Suisse had its own particular problems that led to it being taken out by its biggest rival, UBS, which unsettled markets. But since then, we've seen a further recovery. In local currency terms, though, we are still below the peaks of 2021, albeit we are marching higher every month, which is pleasing. Something that's underneath the bonnet of all of that recovery, though, is that actually, when you look at the US market in particular, the recovery in stocks has been incredibly narrow. So on this slide, we're just showing you the S&P 500, the 500 largest companies in the United States. And in red, it's the market capitalization weighted index. So that's the index you'll see pretty much it referred to in the press. It's weighting every company in that index by size. And then the green index is just taking those same 500 companies, but giving every single one of them an equal weight. So size doesn't matter. And what you can see is that actually it's only really been the largest companies in the US that have driven prices higher this year. In fact, if you took out the largest 6 companies from the index this year, the market would be down to slightly flat. And so what does this mean? Well, our portfolios have still produced, we think, very healthy and robust returns in this environment, despite not having very much exposure to these 6 largest companies, with the exception of a small exposure to Alphabet and Microsoft. And that means twofold. One is that we think more than ever you don't want to be taking a passive approach to investing. Being highly selective and being highly active is more important than ever when these kind of dynamics start to emerge, because you get exposed to these largest businesses for a purely passive approach. But two, because we've actually generated decent returns outside of this narrow market, we think we are less susceptible to it correcting, just because we're not simply exposed to some of those largest companies. So that's the stock market picture in 2022 and 2023. Slightly less rosy picture for bond markets. So far this year, we've already seen continuous increases in interest rate expectations. On the left-hand side, we're just showing you interest rate expectations today versus where they were at the start of the year for the UK market in orange and the US in pinky red. And you can see that we're currently priced in to see significant interest rate rises carry on from today in the UK, going from 5% to somewhere around 6% by the end of the year, and pretty much staying there. And at the beginning of the year, we were expecting interest rates just to come up to about 4.5%, 4.7%. Similarly, in the US, we've also seen an increase in expectations, not as marked as the UK, but you still, further interest rate rises are priced in through to the end of this year, but then potentially even a reduction in interest rates. And that again is up from where we were in December. What's interesting is, this was happening last year as well, but it was negatively impacting both stocks and bonds. This year, stocks have continued to march higher despite interest rates being continually increased or expected to increase. Where it has impacted, though, is the bond market, which has continued to wallow. And this is just showing you sterling bonds going back to the end of December 2021, so that same period as the first slide we showed you on stock markets. The picture is almost identical when you look at US dollar bonds or European bonds as well. And that's one of significant falls in value last year and continuing falls in values through 2023 as a function of interest rates continuing to march higher. There is a silver lining in this, and Ian, I'm sure we'll touch on it later, in that we think for the first time in a long time, bonds have become significantly investable again. And because of these falls in value, we can pick up bonds with really attractive yields when we look forward from today. And so I don't know if you want to mention anything on that, Ian.
I was only going to add, Matt, that what you'll see in that blue line on the chart is some extraordinary volatility sort of September, October last year, and that's the very short-lived Liz Truss premiership with Kwasi Kwarteng's mini budget, unfunded, uncosted, massive growth plans, but scared the market. That then encouraged a sort of a pension fund doom loop of asset sales in gilt markets, and that's where you got that spike. So what I think people still find extraordinary is that 2022 was bad for bond markets because of rates, but it was also bad for index linked. And that was at a time when UK inflation was averaging over 10%. RPI was over 10% on average over that period. So there's often a conundrum in investors' mentality or mindset of how on earth did that happen? Well, unfortunately, it's because inflation linked bonds are sensitive to rates and are sensitive to inflation assumptions. And the 10.5% or whatever average RPI over the period was not enough in a cruel sense to offset the fact that rates were rising aggressively, and they are very long duration assets with very low coupons. So there's an extraordinary bit in there about that blue line, extraordinary volatility in the longest duration. Anything with big duration was hurt most over last year. But as Matt rightly says, that gives a starting point that we haven't seen for over a decade. It's a different paradigm now. Thank you.
And so that's the backdrop for bond markets. I mean, maybe let's talk about what we're thinking about the world as we move forward from today. And just starting with the economic outlook, I'll put some pictures behind these words in a second. But I think really last year and this year have really been around the return to what we call the old normal from the new. The new normal period that existed after the 2008 financial crisis, where interest rates around the world were getting lower and lower and seeing all-time lows and zero or negative in some countries, has come to an abrupt end. The idea that every time there was an economic hiccup, central banks around the world would just print money to try and fix the problem has also ended. And to put simply, money in today's world is no longer free. The last 15 years, a world where you continue to borrow at lower and lower rates has come to an abrupt end. And that's going to have a massive impact on some people that have misallocated capital or borrowed too much. And it's going to make some investment assets harder to realise a return from. We think, in the next few months or going into 2024, there are signs that developed economies around the world are slowing. That cocktail or that combination of inflation and sharply higher interest rates has always historically led to slower economic growth, even potentially recessions in different parts of the world, and leaves some areas of different economies particularly exposed. So whether it's mortgages in the UK or commercial real estate in the US, we think some areas look particularly challenged in this environment of significantly higher interest rates. Some good news, though, is that we do expect inflation to soften as we look forward from today, because some of the drivers of inflation, whether it be commodity prices or some of the supply chain issues post-COVID, have significantly lessened, not just over the past few months, but over the past 12 months. And that will start to feed into the inflation numbers as we look forward from today. The second bit of good news, we think, is that central banks are much closer to the end of raising interest rates than they are to the beginning. And that might sound really obvious, but the reason why we think that is because there's a significant amount of debt in both economies in the UK, US and Europe. And so continue to raise interest rates is going to cause some significant economic pain with that level of debt that we find ourselves in. And so we think that there's a limit to how much further they can go without severely impacting the economy. So again, that is a positive, we think, for all asset classes and financial markets, to see central banks around the world being able to take their foot off the gas when it comes to further interest rate rises. And whilst a lot has changed in the last 18 months, I think two significant issues that have been with us for quite some time remain, and that is that debt globally remains really high by historic standards, and that the world is generally aging. The percentage of people of working age is shrinking, but people are living longer. And those two things combined are not normally great for economic growth. What that means for us, and why we think it suits us, is that our investment style is all about trying to make sure we're invested in companies that do well regardless of how well or badly the world economy is doing. We're not overly exposed to high levels of economic sensitivity, and therefore our businesses can do well even if the world isn't growing at a significantly fast pace. What does it mean for markets? Well, we think in the short term we're going to continue to see volatility. It's unlikely we're going to see a prolonged recovery in bonds or in stocks until we see inflation start to soften and central banks do take their foot off the gas when it comes to interest rate rises. We're expecting kind of slowing growth to continue to hurt more cyclical areas of the market, and therefore for us, quality of cash flows, the quality of the businesses that we invest in, is more important than it has been, and we think it's always pretty important. But if you can be a patient and take a long-term view, then actually looking forward over the next 5 to 7 years, it feels like a very good time to be invested in stock and bond markets, because valuations for both are pointing to good long-term inflation plus outcomes. And for the first time in a long time, as Ian said, over a decade, we think fixed income offers the ability for both return and protection, and potentially generating inflation plus returns. And we haven't witnessed this for almost a generation, which it's almost as exciting as it gets. Just to put some flesh on the bones of that. So this is what we're talking about the change from the new normal back to the old normal. The old normal being the world we saw prior to the 2008 financial crisis, a world of higher interest rates, of money not being free. And you can see in the space of 18 months, we've pretty much gone back to where we were 15 years ago in terms of the cost of money, the cost of interest. This is the US interest rate on the left-hand side, the US 2-year bond as well. Nothing, we think, better encapsulates the world we were in than the aberration that was negatively yielding bonds, where you would lend money to a company or a government, or potentially even a consumer, and expect to receive less back, which seemed bonkers. At one point in Denmark, you could get a negatively yielding mortgage where you would be paid by the bank every month for borrowing to buy a house. It took about 8 years to build up a debt pile, or negatively yielding debt pile, of $18 trillion, which is about 6 UK economies. And it took about 12 months for that completely to disappear. And we think these two things combined, the complete evaporation of negatively yielding debt and interest rates being back to where they are 15 years ago, signals we're moving back to a much more normal environment, which we think long term is a good thing. This is, we think, the good news on the horizon, which is that we are expecting inflation to come down. And when you look at different commodity prices around the world from when they peaked last year to now, you can see they're significantly down. So whether it's natural gas or coffee or copper or corn, all are down from their peaks. All of those things have been feeding into inflation prior to then, and that will start to feed into lower inflation numbers, we believe, as we move forward from today. Equally, some of the supply chain issues that have been with us post-COVID, so the cost of shipping a 40-foot container from China to somewhere else in the world, which I'm sure everyone knew was about $2,500 in January 2020. That spiked at about $22,000 in 2021. And it's come all the way back down to pre-pandemic levels. So again, that will feed through into goods prices and into inflation as we look forward from today, which we think is definitely a good thing for global investors. We've kind of titled this slide, "Expect some naked swimmers." To paraphrase Mr. Buffett, it's only when the tide goes out you see who's been swimming naked. And we think this combination of really sharply rising interest rates and high levels of debt globally is going to leave some investors without their trunks on. We've already seen that happen in a small way in February and March this year, with some of those regional banks in the US go bust. But the last time the US meaningfully raised interest rates, that period we've kind of highlighted in turquoise on the chart, when they took interest rates to 20% of the global economy, sorry, 20% in between 1979 to 1981, debt as a proportion of the economy stood at 31%. Today, it stands at over 120. So raising interest rates to above 5%, we think has just a significant impact, if not more, than when Mr. Volcker did it to 20% in the late 70s. And that caused a couple of recessions in the US and many regional banks in the US, over 1,000 of them, to go bust over the next decade. So we're expecting to see some periods of volatility as we move forward from today because of this. We think that means you need to be more selective than ever in terms of high quality cash generative businesses. And then finally, just to keep it really cheery, these are the two big issues that we think are going to weigh on economic growth as we look forward from today. That the world generally, when you look at kind of government debt piles prior to 2008 through to now, have been marching up quite significantly through time, and that weighs on government's ability to spend on things that help the economy. They can't spend as much on infrastructure, they can't spend as much on supporting their citizens, and that all drags down economic growth. Equally, when you look at the UN predictions for the working age populations in the major economies of the world, they're expected to shrink markedly over the next 30 years. Those people are living longer though, so they're still demanding things from the economy, but there are less people producing things, and that's not normally a great combination for economic growth. So combined with the high debt piles, we think that economic growth probably remains anemic for the next 10 to 15 years. And that means fundamentally, we need to be in businesses that are highly cash generative, that are producing a good or a product that other people can't, that their growth in their products are down to some sort of structural driver, the move to cashless payments, for example, for Visa and MasterCard, or an aging population in the case of Novo Nordisk. That means that they're growing their profits and cash flows year in, year out, irrespective of how well or badly the world economy is doing. So we think actually, all this combined leads to a better environment for the kind of investment approach that we take. The real positive, we think, though, and we'll show you a similar version for bonds later on, is that actually when you take a longer term view, and these are just two return models we use on our team to try and predict what we could be getting from buying stocks over the next 10 years. They are just projections, they're not guarantees, but both of them are signaling decent levels of compound returns over the next 10 years for patient investors. If you buy the global stock market today, we would expect a return based on history of somewhere between 6 to 9% per annum compounded. And if you buy the subset of companies we're exposed to, we think the results could be even better. And as good as they have been for any point in the last kind of 15 years, which makes us quite optimistic about the future. Like I said, we'll touch on the bond part in a second. So just turning to the global direct funds and a little bit on actually what we're trying to achieve, the guiding principles that we manage the three funds to. Fundamentally, everything that goes into our portfolio is there because it's a high quality business. We're concerned about business risk first, price risk second. We think there's a difference between what share prices do and what companies do. And what we need to focus on is making sure we've got high quality, highly resilient, highly cash generative businesses first and foremost. The funds are run with a very long-term time horizon, so we generally aren't trading around every day, every week, every month. We're buying assets with a view to hold them for many years in most cases, and in the case of some of our really high quality companies, forever, as long as they continue to be great businesses and don't get overvalued. The funds are completely unconstrained by a market benchmark, so we won't just buy a business because it is a large company that makes up a large part of the stock market. We think that's especially important given what's happened in the US stock market this year. They're concentrated portfolios, so we only buy our best ideas. We don't just try and over diversify our returns and try and spread out our bets over things just to minimize our risk. We try and buy the best companies we possibly can, put as much capital into them as we possibly can. They're fully globally agnostic, so we buy businesses because we happen to think they are the best businesses globally, not because they're based in the UK or the US or in Europe. Businesses aren't stock markets and stock markets aren't economies. We buy businesses because they are fundamentally exceptional and for no other reason. And combined with those long-term horizons and as a way of minimizing costs for our investors, the funds are designed to have low turnover through time. So how have we done so far? We've just shown you the year-to-date performance on the left-hand side and the inception performance on the right-hand side compared to our peers in the investment management industry. So you can see that the returns this year have been very positive. We've continued to recover, and we are significantly, or very far ahead of our peers. When we turn to our inception performance, given what's happened in US dollar markets globally, it's not necessarily a surprise that the cautious fund, where bond markets are down more than double digits since inception, that we are showing a slight negative return. But pleasingly, the adventurous fund is back in positive territory, and we're somewhere between 6.5% to 5% ahead of our peers over that time frame. So by no means are we ever happy when we're showing a negative return, but we are pleased with the relative outperformance we've delivered and the relative protection we've delivered in what has been one of the most challenging environments for multi-asset investors in over 50 years. Just talking or touching quickly on the portfolio strategy and breaking it down by asset classes. So taking the equity first, we'll always be invested in what we call high quality companies. For us, a high quality company is one that has a product or a service that is difficult for others to replicate. That means that it could be consumer brands, so a business like Unilever that makes Ben & Jerry's soap or Ben & Jerry's ice cream or Dove soap. It could be a business like Novo Nordisk with strong intellectual and investment protections around what it has through patents, the world's largest producer of insulin. Or it could be a very large network of users, so a business like Adobe, which is currently our largest company within the portfolio. But if you've got a product or a service that is difficult for others to replicate and people value, it's mission critical to most people's daily lives, then that makes your business resilient. It makes your cash flows grow year in, year out, day in, day out. And that gets reflected in your share prices through time. That's what we think allows us to deliver high compound levels of return over the long term. And we will always, in the equity sleeve, avoid the most cyclical areas of the market, areas that are very, very economically sensitive or very indebted, which should mean that when the proverbial does hit the fan, we're able to protect capital in more challenging market conditions. I don't know if you want to just touch on the fixed income strategy, Ian, quickly.
Yep, certainly, Matthew. It's very similar in principles to everything that Matt said, because when you lend to a company, bond markets tend to be, well, they are highly asymmetric, and so you're very focused on the willingness and ability of a company to pay you back. And broadly speaking, when you lend to anyone, you want their credit quality to be either the same when it's time to pay you back, or of even better quality. So that tends to come from things like more cyclical, need to pay you more, but maybe it's not enough. We think maybe spreads are a bit tight at this part of the cycle. So we tend to also, in the fixed income area, gravitate towards good quality businesses where you can get decent spread return from underlying businesses, where the willingness and ability of that entity to pay you back is as near to certain as you can find. Now, clearly, if you only pepper the target with the very safest, the Procter & Gamble's of this world, the spread improvement over a government bond is quite marginal. So there is a spread, but then you have to be very mindful. We tend to take quite a diversified approach here, again, recognizing that bonds are asymmetric in their payoffs. You've got a predictable payoff at initiation when you start the position. You really don't want surprises. So we have well diversified by sector. We don't tend to have many cyclicals. We tend to be biased towards higher quality than the average indices. Most indices these days are BBB on average. We tend to be running at single A, A- in the quality, and we've been upping that, not a spoiler alert about current positioning, but we've been upping that in quality as spreads have become tighter and give you less compensation in all-in yields. Well diversified list, great quality names, good quality businesses where you feel like the willingness and ability is assured.
Great. And just on alternatives, we do have a couple of alternatives within the funds. These are really to give us some more diversification from the bond and the equities. That tends to be gold and a couple of very selective hedge funds. It's a very small part of the portfolio, less than 10% as we sit here today, but really gives us some diversification, which was very valuable last year when both equities and bonds were selling off. So this is the asset allocation for all three funds as at the end of June. As we go up the risk profiles, the amount in equity increases. We are typically towards the higher end of what we consider the allowable or maximum range for stocks and shares at the moment. And that's partly a function of the fact that even though bond returns have significantly improved, we still think you're going to get a good long-term compounded return from the stock market. Another kind of nuance to let people know about is that when you're in the ventures fund, we don't own any corporate debt. We only own government bonds. They're to purely diversify against the equity. We don't need to load up on risk when we're already taking quite a lot of risk through buying 75% in equities. But as you move down to balanced and the conservative fund, we do start to buy some, as Ian said, high quality corporate bonds, which Ian will show you later on.
But also, just to add to that as well, Matt, that we differentiate within the bonds. So we're not only holding no corporates where you've got a lot of equity risk factor, because we want to offset that with the sovereigns. Duration profile also increases. We tend to run our corporate positions quite short duration for the return seeking attributes, particularly in the conservative and balanced funds. But then when you go into longer adventurous, you want more duration, you want sovereign duration, you want more offset against the equity positions, just in case things have to dampen volatility along the journey.
Yeah, exactly. And we can give you full details on portfolios if anyone does want them. This is the equity sleeve of the Adventurous Fund as at the 30th of June. It's identical for the Balance and the Conservative Fund. So it's the same 27 companies that make up the equity sleeve in all three. We just increase how much we have in them as we move up the risk profiles. All of those businesses have, what I said before, advantages that are difficult to replicate, are mission critical to people's daily lives. Adobe is seen almost as the Microsoft and for most people's creative software. Just as like you and I might use Excel and Word, if you're creative, you're using Photoshop or InDesign. The sectors and the stock market listing on the right hand side are purely an outcome of where we find the most exceptional businesses. So what does that mean? We don't try and target X% in the UK or Y% in North America. It just happens to be that's where we're finding the best companies as we sit here today for the price we're paying for them. Similarly, sectors we think are more a nonsense than they ever have been. There was a reclassification of a lot of our companies at the beginning of this year. We haven't bought or sold any of our 27 businesses this year, but we have somehow decreased information technology from 25% of the portfolio down to 16%, and those companies have been reclassified into financials and into industrials. So businesses like Visa and MasterCard, which were viewed as technology companies at the beginning of the year, have been reclassified as financial businesses. Similarly, Automatic Data Processing, the 24th largest business we own, was a technology company as well. It's a payroll and HR business really, and has been reclassified as an industrial. So we view the companies first. What we get is the sectors and the stock market listing. And a really good way we think of showing that is just showing you where the actual sales of our businesses come from. This is how we truly look at risk in our portfolio. We think about where do the revenues of our companies come from. It's a way of us making sure we're controlling risk. So we have no Asian listed or emerging market listed businesses in our portfolio, but over 20% of our sales or revenues come from the Asia Pacific region. And that's a way of us having our cake and eating it. We get exposed to the Asian consumer, we get exposed to where the economic center of growth is moving to in the world. But we do that without getting exposed to some of the geopolitical risks and tensions that come with investing directly into those stock markets. Similarly, while the UK is 15% by listing, only just under 3% of our sales come from the UK economy. So whether the UK does well or badly, and we think it's a bit of an economic basket case at the moment, it doesn't have a material impact on our portfolio. Some of those UK businesses like Unilever, even though they happen to be based over in the UK, 60% of their sales come from Asia and emerging markets, and the largest single country exposure they have is India. I think really importantly, and I think probably for me the most important slide in the pack, is the table on the right hand side, which is just measuring. I don't think anyone will ever sit in front of an investor and say we buy a load of rubbish but we buy it really cheap. I think everyone says we buy good quality assets, but we should always be able to measure to you the quality of our portfolio and whether it is superior to the wider kind of global stock markets. And it's really the quality characteristics we have that give us the ability to consistently grow capital through time, but also protect us from inflation, protect us from interest rates, protect us from a slowing economic environment. And we've kind of shaded in red and blue what we think are the most important statistics today when it comes to inflation protection or interest rates. So when we look at the portfolio, our companies are generally generating a higher return on capital than the UK or US stock markets. They're much more profitable and they have higher profit margins. We think a sign of whether a business is producing a good or product or service that others can't is that they will have high gross profit margins. What does that mean? It's the difference between the cost of making something and the cost of selling something. Our companies, it costs about 44p, 44 cents to make something, and we sell it for $1 or £1, so we get a gross profit margin of 56%. That's more than double the UK average. It's almost double the US average. So that allows companies to protect themselves from high inflation, and that's proven to be the case so far this year, with a lot of our companies growing their revenues by double digits because they've been able to increase their prices by double digits. In the world looking forward from today, though, we think actually it's the interest rate issue that is going to be most pertinent to the portfolio. Inflation is coming under control. The issue we have now is we're stuck with interest rates as high as they have been in over 15 years. And the best protection, we think, against higher interest rates in the equity portion of the portfolio is to make sure we're exposed to businesses with very little debt. And so when we measure debt against capital or against earnings, you can see we're significantly below the average UK or US business. And really importantly, interest cover, how much time do our profits cover how much we spend on interest every year? We're at 37 times compared to the average of 7 and 9 times in the UK and the US. And so that means that even if we have significant interest rate rises from here, our companies are going to be just fine. And many of them are going to come out of this period stronger than they went in. Just to give you one quick company highlight before I hand over to Ian on the bond section, is our largest business in the portfolio, one we bought last year, Adobe, which is a leading multinational software company, but focuses on predominantly creative software. So I always like to think of it as the Microsoft for creatives. The businesses, elements like Photoshop or Flash or InDesign are used every day in quite a lot of creative agencies. The software is seen as being mission critical to most people's daily working lives. It makes the company's revenues really sticky and really resilient. And that's combined with the fact that 90% of all the revenues they get are based on subscriptions, which means that people are paying a little amount every month. So it makes it much less likely they're going to cut back on that cost through time. It makes it, again, much more sticky. And something really exciting for Adobe is that they've already announced this year that they're going to be generating revenue from AI-based tools by the end of 2023. And that's led to the stock being up almost 60% so far this year. I mean, when you look at the financials, again, we think this is a definition of a great business. So gross profit margins of 88%. What does that mean? It costs them about 12 cents to make what they produce. They sell it for $1. They bank 88% profit on everything they do. Revenues, even though the share price was down last year, their sales grew by 12%. And since the start of the pandemic, their revenues are up over 65%. And this is exactly the type of business we try and put into the portfolio, one with recurring revenues that's mission critical to people's daily lives, really profitable and able to defend itself from an inflationary environment really easily. And that's been rewarded since we bought it. We're up about 50% since the time of purchase. Ian, do you want to touch on bonds?
Yes, certainly. I think we know it's been quite a journey in yield curves in both treasuries and tips, and I think you can see here go back a year and the significant change. And Matt's absolutely right that the refinancing risk is great. It's clearly greater for more leveraged companies, as Matt rightly says. It's clearly greater for more leverage and more cyclical, where you're going to feel more pinch points, and they're coming. That tends to be why in the portfolios, certainly in the fixed income allocation, we have an extremely light weight to anything cyclical or anything that's sub-investment grade. Where we do have something sub-investment grade, it's because it's a senior parent, it's a subordinated part of the capital structure from a senior parent that is quality, that is well rated, that is investment grade standard. It's just more of a seniority problem or issue than it is choosing companies where I think the spread compression is arguably not enough, and the refinancing is going to be a bit of a problem. When you were borrowing at down at 2%, all of a sudden to have to borrow up at 6%, that's significant. It's even more so for more cyclical businesses, less desirable, less pleasant, lower rated entities. What we do know is where we get some comfort, though. Matt's talked a little bit about the positive outlook from here, and as painful as 2022 was and the start of this year's been a bit tricky, particularly in the UK, where we've seen much more sticky inflation than other parts of the world, and we've reverted back to a 50 basis points hike over here whilst the Federal Reserve stays on pause. But it's also worth remembering that the pause doesn't mean it's ending. There will be another hike at least priced in, and we've seen that from the Reserve Bank of Australia as well and the Royal Bank of Canada, who have both posited pauses only to then resume rate hikes. But I think what we're seeing is that there's a bit more nuance in the market. The market has priced quite a bit in. And I think for us, we get a bit of comfort where we think if we look at the US 10-year, for example, it's now effectively at the same level as it was at the start of the year. And that's despite the fact that we've had 2 hikes since the start of the year. And if you go all the way back to October last year, we've had 200 basis points worth of hikes since then, and the 10 years lower. So the market's looking through and wondering, gosh, debt loads, this deliberate demand compression or force taking rates up to affect demand alongside maybe a fiscal squeeze and all other sort of demand drivers that might destroy a bit of demand are actually quite potentially problematic. So at the minute when you can get, you know, peppering around the 4% target on the US 10-year, we feel like you get a sort of a bit of an each way bet. Maybe you can start building in some portfolio insurance, but finally get paid for it. Back in the day when they were at much lower yield levels, you might have picked up some portfolio insurance. It would have been the wrong thing to do, clearly, but not getting paid very much while you were there. Currently, there's a lot of opportunity set across the marketplace. We've got here the TIPS market as well on the right-hand side. Now, this is the Treasury inflation-proof securities. It's worth remembering, as I highlighted earlier, that inflation-linked assets do react to changing rates, so they are not a full-on safe haven. What we have done actually in the conservative fund, we've added a bit of US Treasury inflation-proof securities for that sort of intermediate maturities. We think that's more a return-seeking trade. That's why they're not in the balanced and not in the adventurous portfolios either. But I think there's you know, it was been painful period, but now you can get, you know, near 4% on the 10-year for the US feels about right for us. Picking up 5 to 6% from good quality short-dated investment grade corporates again feels not a terrible trade either. Where we do have some worries is probably in more exotic credit. I think spread product is probably maybe a little bit too richly priced in general, so we certainly don't want spread duration. So we're keeping all of our corporate bond exposure at the short end, where we can take advantage of these very high near-term yields and get a little bit of extra spread compression enhancement on the top, and taking our sovereign risk, our risk reduction, our portfolio positioning moves just that bit longer in sovereigns. And we've been increasing duration since the turn of the year into this. As yield curves have been selling off and going higher, that's been the perfect time for us to start allocating more to those parts of the market, and that feels entirely prudent. That will probably carry on. What we've got here is the whole portfolio, well, the top 20 at least, senior corporate bonds. Hopefully the names are familiar and there shouldn't be any broad surprise, and hopefully it sticks with the quality theme. Recent additions were the likes of Apple and Nestle. Again, quality names where you don't think you're getting paid too much for spread compression. Maybe gravitate more towards the quality. Average portfolio corporate credit quality A-. I mentioned they're A- area at the minute, which seems to get about fine. Average duration here is probably nearer to about high threes now, pushing it up towards 4 on balance. It's about 3.3, 3.5 now on conservative, and it's up at 7. Remember, that's all sovereign nominals, long in adventurous. I've got a 14% allocation to bonds in adventurous, quite small. I need to use most of that for its maximum effectiveness in a portfolio. So I want lots of 7.7 years duration, mainly US Treasuries, but recently added a few UK gilts in there as well, given the significant sell-off we've seen in the gilt market, and expecting a bit of a repricing back to more normality as the demand destruction and constraints hit. And that is the bond portfolio.